Hi there. Claiming home office expenses can be legitimate, but poor records or incorrect claims may attract additional HMRC scrutiny.
Welcome to The Explainer. Look, if you're the director of a UK limited company and you've recently built one of those amazing garden offices or set up a dedicated workspace at home, you really need to listen up. We're looking at some absolutely massive changes to UK tax rules coming in the 2026/27 tax year. The landscape of corporate taxation is shifting, and we're entering an era of intense, systematic digital scrutiny from HMRC.
Picture this. You've got your pristine new workspace set up in the spare room or out in the garden, and you're claiming that standard £6 a week deduction on your self-assessment. Right now, that seems totally fine, doesn't it? But here's the kicker. Under the new rules, that standard little deduction could actually trigger a totally automated audit. We're going to break down exactly why this is happening and, more importantly, how you can protect yourself. To help us really get to grips with this, we've teamed up with the absolute best. This explainer was put together directly using the insights and research from the seasoned tax advisors over at Atlas Tax Advisors, or ATA. They are a top-tier UK accounting firm, and they spend their days helping businesses master HMRC compliance. They've gone through these 2026 updates with a fine-tooth comb, and their goal here is to make sure your business is fully prepared for what's coming.
Okay, let's dive right into it. The ATA advisors have broken this down into 6 clear areas. We've got 1. The 2026 tax rule shift. 2. HMRC's automated red flags. 3. The capital gains tax trap. 4. Avoiding exclusive use pitfalls. 5. Practical steps for 2026. And 6. Summary and professional advice.
All right, let's kick things off with Section 1, the 2026 tax rule shift. Now, obviously, sole traders and regular employees are going to feel the impact of these changes, but today we are shining a massive spotlight on the really complex position of the UK limited company director. So, historically, basically right up until April 2026, if you work from home, you could just log into your individual self-assessment or payee portal and make a quick, standalone claim for your home office expenses. Super simple, right? Well, the government is completely flipping this script. They want businesses to handle these expenses internally now. So from the 6th of April 2026, that freestanding individual claim, it's gone, abolished entirely. You literally cannot do it anymore. Instead, you're going to have to process this through formal employer reimbursement via a strict corporate policy.
And honestly, a lot of people totally overlook this detail. As a company director, you have a dual role, right? You're both the employer and the employee. Because you can't make that personal claim anymore, you have to proactively put on your employer hat. In the real world, this means you need to draft an actual board minute or an internal policy document that explicitly states the company requires you to work from home and exactly how those costs are reimbursed. It's the only way you can legitimately keep paying yourself that £6 a week or your actual evidenced costs without getting taxed on it. If you skip this administrative step, you just lose the relief. Simple as that.
Moving right along to Section 2, HMRC's new automatic red flags. How are they actually going to police this? Let me tell you, it is absolutely fascinating. I want you to burn this number into your brain, £2,500. Under HMRC's new digital campaign looking into private versus business expenses, if your business expense claims cross that £2,500 mark in a single year on your self-assessment, boom, it triggers an automated red flag on their system. And think about it. If you buy a decent laptop, an ergonomic chair, and claim a chunk of your broadband and utility bills, you're going to smash right through that ceiling in a matter of months. Doing that puts a massive, glowing spotlight right on your tax return. They are actively hunting for unusually high mixed-use expenses. Did you know that HMRC audits are practically never random anymore? Seriously, a staggering 93% of compliance investigations are triggered by algorithms. HMRC uses this absolute beast of a data matching supercomputer called Connect. It's essentially comparing what you claim for your business against your private lifestyle data, mortgages, car finance, and crucially, property records. So if you just got planning permission to build a fancy garden office, Connect already knows. And if your home office expenses look way out of whack compared to your business's turnover or your home's footprint, that algorithm is going to flag you. But wait! It actually gets wilder because the surveillance doesn't stop at tax. Starting in April 2026, HMRC's data will be shared live with the UK Home Office. This is a game changer if your business holds a sponsor license for international workers. A basic, routine check, maybe triggered by a clumsy Home Office claim, could expose broader PAYE or salary mismatches. Those anomalies instantly get fed to immigration authorities.
And no joke, that can trigger an immediate revocation of your sponsor license. A silly admin error on a home office claim could literally cost your international staff their visas.
Okay, let's head into Section 3. This is where a tiny deduction today can blow up into a massive headache tomorrow. We're talking about the capital gains tax trap.
Normally, when you sell your main home, you don't pay tax on the profit, right? That's thanks to Private Residence Relief, or PRR. Under Section 224 of the Taxation of Chargeable Gains Act 1992, you get full tax relief. But there is a massive, often ignored condition. This relief is totally wiped out for any part of your home that is used exclusively for business. Exclusively is the dangerous word here. Imagine your property value jumps up by $100,000. PRR usually protects all of that. But if you've got a dedicated garden office taking up 10% of your property and you've claimed it's for exclusive business use, you've just stripped the tax-free status away from $10,000 of your profit.
And here comes the real financial sting. When you finally sell that house, the gain tied to that exclusive office space gets hit with capital gains tax. You're looking at 18% for basic rate taxpayers or 24% for higher rate taxpayers. So going back to that example, that $10,000 of unprotected gain, that would cost a higher rate taxpayer $2,400 in tax. Oh, and under current rules, you've got just 60 days after the property sale completes to calculate, report, and pay that bill. Ouch.
Look, this is a trap many people only discover way too late, usually when they're sitting down with an accountant after selling their house. But there is a silver lining. As this direct quote from HMRC's own internal manual states, the exclusive use test is a stringent one. Any room with some measure of regular residential use should not usually seek a restriction. Basically, if the room has some normal home life use, HMRC says you shouldn't get penalized. That right there, that is our golden escape hatch.
Which brings us nicely to Section 4, avoiding exclusive use pitfalls. Any good tax advisor will tell you that the secret here is all about proactive, strategic planning. The brilliance of this strategy is that you actively want to break the exclusive use rule. You need to break it to save your tax-free status. If that room is 100% business, you fall straight into the CGT trap. But if you can genuinely prove that the space is mixed use, meaning it serves both your business and your personal life, you preserve that tax-free private residence relief for the whole property. So how exactly do we establish mixed use? Professional tip from the ATA guys. It is surprisingly easy if you just plan for it. Literally just put a guest bed or a pull-out sofa in the office. Have a family computer in there, or keep your personal hobby stuff in the corner. Let your kids use the room on the weekends to do their homework or play video games. And importantly, just keep a really simple informal log that proves the room is used for non-business stuff. By deliberately sharing that space with your family life, you completely neutralize the capital gains tax threat.
Let's get down to brass tacks. Section 5, Practical Steps for 2026. How do we translate all these rules into compliant, bulletproof actions for your limited company today?
Step 1, you absolutely must draft and implement that formal corporate reimbursement policy well before April 2026. Get it in writing how the company is reimbursing you for working from home. Step 2, take a hard look at your workspace right now. Make sure you've got that documented mixed-use setup, the guest bed, the family computer, to protect your home's tax-free status. And Step 3, if you are claiming actual apportioned cost instead of just the £6 a week, you need flawless digital receipts. No more trying to guess your expenses at the end of the year. Keep a cloud folder or use proper accounting software.
And speaking of software, you really can't rely on a shoebox full of crumpled receipts anymore. Also launching in April 2026 is Making Tax Digital for Income Tax Self-Assessment, or MTD-ITSA. If your qualifying gross income is over £50,000, you are legally mandated to use compatible software, keep digital records, and submit updates quarterly. You'll be connecting bank feeds straight to HMRC-approved systems. Accurate digital record keeping isn't just a nice-to-have anymore, it's a strict legal requirement, and it acts as an enforcement accelerator for every single rule we've talked about today.
Wow, okay. We have covered some incredibly vital ground today. Let's bring it all home with Section 6, Summary and Professional Advice, distilling the absolute biggest takeaways from the team at ATA.
If you only remember 4 things, make it these. First, the standalone £6 a week claim dies in April 2026. You need a formal company policy to replace it. Second, remember that £2,500 threshold. Cross it and the Connect algorithm will flag you.
Third, claiming a workspace is exclusively for business triggers an 18% or 24% capital gains tax bill when you sell your home. And fourth, intentionally creating a mixed-use space is your best defense to protect your private residence relief and your hard-earned wealth.
So, I want to leave you with this thought. Think about your exact home office setup right now. Is it possible that a tiny £6 a week deduction today might inadvertently cost you tens of thousands of pounds in capital gains tax tomorrow? It's a terrifying financial consequence, but the good news is it's entirely avoidable if you act right now and structure things correctly.
Before we wrap up, please remember that this explainer is for general guidance only and doesn't constitute formal financial or tax advice. These rules, as you can see, are incredibly nuanced. To really safeguard your business, your property, and your personal wealth from these aggressive 2026 audits, I highly recommend you reach out to the experts at Atlas Tax Advisors for personalized advice tailored to your exact situation. Please don't leave your compliance to chance. Thank you so much for joining me for this explainer, and I will see you next time.